Welcome to the Trader Merlin Show with your host, Merlin Rothfeld.
Hello everybody, welcome to Trader Merlin and another chaotic market. I think we're going to change the name of the show from Trader Merlin to just the 1,000-Point Show. Because say hello to Brendan and Mark and Tiger as well. You can also go to tradermerlin.com to send in any questions along the way, and I have a couple of those I will answer probably near the end of the show today once I have some time. All right, let's start off with our market update, which is another one of these, are you kidding me? Normally the market update type of stuff you see on TV, it's rather boring and monotonous. It's like, okay, the S&P moved 1/4 of 1%. Not for today's market update, guys. This was one of those, oh my God, are you kidding me again? I'm going to start off with the worst one, which is just a head shaker, I will tell you. The crude oil chart today definitely caught me off guard. I lost quite a bit of money today going the opposite direction on crude oil, just waiting for that thing to bounce and turn around. We were getting near that $20 mark on crude oil, which is just absolute shocker. So TJ's going to bring that chart up, and there it is. Huge down move in crude oil today. You saw it down at the end of the day. It's $16, or sorry, down 16.66%. Got a nice little slip there. It may actually be at $16 soon. You'll notice that the low on this bad boy for today for crude oil was $20.52. That is absolutely brutal. I mean, you talk about getting slaughtered. The futures markets for this one was nuts. I was trying to pick some lows, and it just was not working for me. So yeah, I took some pretty big losses on crude oil today. Hopefully we'll make up for those over the next couple of days. Cool. I'm glad some of you guys made some money out there today. That was number 7. Again, down 16% at the end of the day. That's when it closed at 22.46. It's right now at 22.80, so still moving up in the after-hours session. My guess is you're going to get a sympathy bounce here because that is just a huge down move in crude oil. At a point like this, even the Saudis and the Russians are going, "Duh, comrade, we cannot make money like this. We must raise the price of crude oil." So, my apologies, any of my Russian viewers out there. All right, number 6, let's go to the Russell 2000. We're going to take a peek at that RTY futures contract, and there she is. Not as bad as you see with crude oil, but still on the day, another 10.42% down day. That's unbelievable. If you think that the Russell 2000 was at 1,700 in February, and here we are sub 1,000. That means you lost almost 700 points in that index. You're getting close towards that 50% decline. I know, it's close. It's going to be a little bit longer, but crazy, crazy downside moves here. I'm loving the February 19th show that we did for Power Trading Radio. 991 is where it closed at. Right now you're at 1,006, so it has bounced above that 4-digit mark there for the Russell 2000, but still 10.42% slide. Ugly. All right, what's our next victim out there? Let's go to, what do we got? Dow Jones was down 1,300 points yet again, so closing below 20,000. And by the way, from the Dow's perspective, you've erased 4 years of market gains in just a period of about a month. So they say the markets take the stairs up and the elevators down. I think this is more of a jumping off of a base jumping type of situation. There's no elevator here. Number 5, S&P 500. Here is your ES. Also a big slide, over 5%, 5.18%, closing the day at 2,398. Ugly move as well. Nothing technically here that really makes me feel comfortable with the S&P at all, but that's your chart. NASDAQ also showing some significant punishment, down 4.7%. The composite was finishing at 6,989. What's nice about this chart, the only nice thing, is the candle that formed today has a very long bottoming tail, which basically means that near the end we had a nice rally up and things started to look positive for crude oil, or sorry, the NASDAQ, but all in all it was a down day. So you had those negative numbers. Now we're moving into the podium time, which is still going to be ugly. Gold. Again, I still think this is people cashing in. You're hearing a lot of pundits say, let's shut down America for 30 days, everything across the board. Of course, you know that would be devastating to businesses and people now going, wait a minute, am I going to have cash to even go buy groceries or survive? So we're seeing many people look at banks and say, hey, I'm pulling my money out, maybe even pulling money out of gold or other assets, which would normally be safe havens. Because it's not just a market pullback or a correction or recession. It's all of a sudden a market pandemic, not from a disease perspective, but just people going, where's my money at, and freaking out. All right, number 2 is Bitcoin. Bitcoin actually, let me see, we refreshed this one because I had it as number 2 on the list, but it could have changed because it's been super volatile. Down 2.72% on the last 24 hours. Nothing really noteworthy out there with Bitcoin. It is the 10-year Treasury note that brings us some noteworthiness. Here is the futures contract for that 10-year U.S. Treasury note, and you can see Again, that big pullback selling off, that means that yields rose significantly. Today we saw the yields rise to 1.26. Remember, just a couple of days ago, we were at 0.5. Now we saw a 27% rise in the yield of that 10-year Treasury note. And that, my friends, is your top 7 markets today. Hopefully some of that put some green into your pocket. All right, since we ended on that 10-year Treasury yield, there's been a lot going on with the Fed. We've seen them, again, firing their bullets out there and trying to help this market, which for all intents and purposes is in a free fall. But is it doing any good? And what the heck does it all mean? Should they be doing it at all? Well, I can't answer those questions. I have my opinions, as I'm sure many of you out there have opinions. However, when I have questions like this, I like to bring on the people who have been doing this a long time and are experts in that specific field. Today we have a bond expert on the program. We've got Bill Addiss joining us. And Bill, how you doing today? Oh, I guess I should probably unmute your Skype. There you go. How you doing?
Right, great. How's that audio? Can you hear me?
You sound fantastic.
Relatively speaking.
Yes, yes. All right, since it's your maiden voyage on this new show, Trader Merlin, let's at least give our viewers a little bit of a profile. So TJ will run a nice graphic for us saying, here is our trader profile. Now, Bill has been doing this a very, very long time, and I wanted to just kind of share with everybody, maybe tell us a little bit about your background, maybe how you got into this, kind of what you look for in the markets.
Sure, and it's a pleasure to talk with you again and your new audience and the old audience at the same time. So, yes, your emphasis was on Bill has been doing this a very long time. And I guess the emphasis is on very, because this year I'm 42 years, and almost all of my professional time in the market has been associated with the bond market. I started with a firm called E.F. Hutton back in '87. Hutton got bought by a firm called Shearson. Shearson got bought by Lehman. I kept getting merged and assimilated. And survived the mergers, but I spent 42 years, or 32 years rather, with the combined firm. And when I left Lehman, I was a managing director, executive vice president. I had spent my entire life in the bond market, either as a bond trader. I was also in research for a little while, but I also managed 2 divisions for the firm, for Lehman. So my specialty, if you will, about 12 years ago, when I left Lehman, and I left Lehman before they went under, so timing is everything in life. But when I left Lehman, I decided to set up my own capital markets training firm. So I now do my own firm, and I do capital markets training for worldwide for a variety of institutions, both on the buy side, the sell side, regulatory. Up until this month, I was on the road about 250 nights a year throughout the world doing capital markets and derivative training for the institutional market. So my working with you and working with the OTA formerly and now with your new site is really my first entree to working with the retail individual. And I've really been enjoying the experience. So I'm looking forward to continuing to provide some market updates and some insights into the Fed and what's going on in this marketplace.
Yeah, and there's a lot to talk about in that space. And I thank you for the update. And viewers, you'll probably start seeing a lot more of Bill Addiss here on the program because he's one of the only guys I know that has such a specialty in the bond markets and pedigree. I mean, when E.F. Hutton talks, people listen. You got Shearson and Lehman. I mean, these are pedigree in the financial world. Some aren't around anymore, but still, it was the knowledge that you brought to the situation for these traders and understanding how they act is certainly good for us. Walk us through. Well, let's take a step back. First off, today was supposed to be the FOMC announcement, pretty much priced in a full 100 basis points cut, which, to me was kind of unprecedented given the fact that just 2 weeks earlier we had a 50 basis point surprise cut. So 150 basis points in 2 weeks. To me, this is basically watching the airplane and watching this steaming pile of doo-doo smack into a fan and just blast all over the wall. I mean, this is like them showing the world that they are freaking out. Am I right?
You are 100% correct. And the real message of that was the fact that they did this last announcement on the second Sunday in a row.
Right.
As you mentioned, they had an FOMC meeting scheduled for this week. They could just as easily have, made the announcements as part of the regular announcement. But they obviously saw something over the weekend that scared the heck out of them, that they felt it was necessary to respond immediately on a Sunday night for the second week in a row and not wait just 3 days for the regularly scheduled FOMC meeting. That's the part that really took me by surprise.
Yeah, what do you think that they saw? Because we know, and you've brought this up repeatedly, that they've been really transparent. And, we've seen the data supporting rate increases. Now, I think maybe the anomaly here is that we are now just starting to see some data which may paint a different picture. And this data, I think, is going to swing so quickly. I heard somebody say today that Mnuchin is basically projecting a 20% unemployment rate here in the next couple of months, and I totally agree with that. Is that the reason why they're doing this?
Yes. Honestly, it comes down to they got freaked out, and for good reason. The Fed had come under a lot of attack for keeping interest rates too high over the last couple of years. But the benefit is, and we get to look at that, is we've now got some wiggle room. As you said, in 2 weeks, our Fed has cut interest rates by 150 basis points on the Fed funds rate.
Right.
That's a real shock to the market. I mean, the Fed is trying to do everything they can, literally kind of, as you said, throw it all onto the fan and see what happens. But 150 basis points on the Fed funds rate in the last 2 weeks. They cut the discount rate down to 0.25%. They're permitting discount window borrowings. They're basically saying to the banks, you can come in and borrow up to 90 days from the Fed. It used to be just overnight. I'm not an equity guy. You are much more proficient at that. But I think what we saw on Monday was the fact that the Fed was so aggressive in terms of doing everything they possibly could on a Sunday night that I think even the equity markets got a little scared on Monday, saying, well, this is obviously serious.
Yeah. And that's the tricky part here. I'm looking at the times the Fed has performed this type of monetary intervention or rate intervention, I'll call it. And, my trading experience isn't as lengthy as yours, but I remember very vividly what Greenspan did in 2000 when we saw that really aggressive, sharp sell-off. I mean, we're talking 50 basis points of price cuts, and that was nuts. And then you saw what Bernanke did back in 2008, and of course, you see and understand how they're utilizing these rates to stimulate an economy. And if we look at what we saw in 2000, that was a bubble, a tech bubble, completely overinflated, bound to crash. That was expected. You look at the financial situation that happened from, let's say, 2003 to 2007, the build-up, the ramp-up there, over-leveraging, a fog a mirror, get a home loan. That was bound to collapse as well. Some people saw that. There was capitalization there. But it wasn't necessarily a full systemic failure. It was really kind of the financial crisis. This situation is one that leaves me scratching my head because only time I've seen anything like this is by watching stuff that was produced in Hollywood and sensationalize it, and I've got a bowl of popcorn with me and I can walk away going, wow, that was pretty crazy, that'll never happen. And here we are today, all I'm missing is tanks rolling down the street shouting through megaphones, get back in your home, get back in your home now. I mean, I'm waiting for this. This is now something that instantly, systemically shuts down businesses across the United States and the world for that matter. So what difference does it make when you have a turn off the switch of the economy? Literally, they turn that switch off and nothing's really working. Yes, I know some of you are going, well, there's restaurants and there's essentials. Yes, but the bulk of jobs, I mean, Tesla factories shut down, all this stuff is shut. What good does it do to drop 150 basis points? To me, it doesn't make any difference because it's going to get swept up and ignored in the overall panic and fear of these markets. I mean, we're in a free fall, and all of a sudden you make this announcement. I don't think people care.
I agree with you, but I also have to add a but to that.
Yeah,
because I'm of two different minds of this. I mean, fundamentally, you're right. No matter what the Fed does, you cut interest rates down to zero where they are now. That doesn't cure a virus.
Right.
That doesn't put people back to work. The Fed is responsible for fiscal policy, for monetary policy, and they can't avoid a recession if 20% of our people are going out of work. So I do tend to agree that there's only so much the Fed can do. They're not going to cure a virus. They're not going to cure a recession. But I do think that the financial markets are looking for some sign that the Fed is trying to be as proactive as possible. And I would equate the same thing to, the president and the government. When they've got some indication that people are on top of things, they're less likely to be scared than if there's no reaction going on whatsoever. So on the one hand, I do want to agree with you that, the Fed cannot cause a recession not to happen. The Fed is not literally going to be able to get people back to work. But I think the fact that our central bank is looking to be so responsive and so aggressive, I think the world is going to take some comfort from that. Now, again, how do you prove a negative? How do you prove what would happen if we didn't do this?
Right.
But I do think within the tool chest of what the Fed has available to them, they're trying everything they possibly can. And the market should take some solace from that.
Sure.
I would point out Tuesday's announcement from the Fed about the commercial paper market was probably as important to the economy as anything the Fed did Sunday night. Because, just as a reminder for the people listening, is on Tuesday, the Fed made the announcement that they're going to be reinstituting the commercial paper funding operation. And what that basically means is the Fed is going to go out and start buying commercial paper directly from corporations. This is one of the few ways the Fed can actually directly impact corporations. Normally they deal through the banks, they do through the dealers, but the Fed Tuesday said we're going to go out and just start buying CP directly from corporations, bypassing the banks.
Yeah.
So this again is trying to help them get some liquidity, help them get some cash. Firms are going to be starting CP programs just to sell that paper to the Fed to provide some liquidity. So, within their tool chest, they're really pulling out every tool they possibly can in an effort to try and give the market some confidence. And when you were recapping today, what really concerns me about today is the fact that everything was down.
Yeah.
Literally every asset category was down. You mentioned bond yields have gone from 50 basis points on the 10-year. Right now we're at 1.2.
Yep.
Yields up again today, prices down. Assets like gold, oil. The concern to me is literally there's just panic selling going on everywhere today.
Yeah, and let's go to two things. You covered a lot of ground right there. I want to make sure we touch bases. And yeah, look, I think that the Fed at some point should have cut rates, but to me it just gets washed up in the noise of everybody thinking they're all going to die in a couple of days. I have friends who literally have called me shaking, saying they're having an anxiety panic attack because they're afraid that they're going to die. And I'm like, relax, stop, calm down. It's not the Spanish flu. It doesn't have a high mortality rate. If you happen to catch it, and by the way, does anybody here watching right now know anybody who knows somebody who knows somebody who knows somebody who has gotten this virus yet? My cynicism tells me that this is manufactured and it's just a bunch of fear-mongering. However, it is probably a real thing, and I'll see some of the results here soon. But it's not as dangerous as some other pandemics we've had, so relax. I don't think we need to completely torment our lives. That said, the Fed dropping 150 basis points, to me that was I hate to say it, a poor decision, because what I think should have happened is, let's say we go through this 2-week quarantine. I know a lot of cities are now, Costa Mesa, where I'm at, and San Francisco, Orange County, LA, locking things down for, let's say, 2 weeks, down to really March 31st. So at the end of March 31st,
all the tools in their arsenal, and as we just said, this is not going to cure the pandemic. So I kind of agree with you. I wish the Fed would have been a little bit more balanced and taken their time. 100 basis points, bringing it down to zero. We've been speculating in other calls about the prospect of negative interest rates here in the U.S. Well, we're at zero. So, as Alan Greenspan himself said, zero is just a number.
Yeah.
And I do worry that they kind of tried to make a statement, but in doing so used literally all of the arrows in their quiver in terms of tools they can use.
Yeah, absolutely. So let's continue on with that one. I want to get back to the corporate debt side of things. It's important for an agency or an institution like the Fed to have those arrows in their quiver. At this point, to me, they shot all those arrows, and personally, I think that it was like firing blanks. I don't think that they were going to do any good. Maybe down the road they will, and I'm sure it will when you have zero interest rate policy. It's just, again, the emotions right now in America are running so high that I think it got glanced over. When we look at
Treasuries out, kind of like a collateralized loan. Well, they're now up to $1 trillion a day that the Fed is doing of dumping cash into the system. That's on top of announcing on Sunday quantitative easing. Ben Bernanke got the reputation of being helicopter Ben. Remember, he was just dumping money down onto the U.S. economy for quantitative easing. That's nothing relative to what Powell is doing here. We got to come up with another name.
Yeah,
Avalanche Powell.
Yeah,
he's just flooding the system with money.
Let's see, what's something that has a lot of, it starts with like tsunami Powell, because it just keeps flooding the market with capital. Interesting, there was a comment that was made earlier by one of the viewers. Yeah, I don't know what's happening. There's something going on with the stream, guys. Sorry about that. There was a comment earlier, there's obviously talks about giving every American $1,000, and it was funny because one person puts in there, tax me $1,000 and then give me $1,000 back. It's like, yeah, you're probably there. And the funny part is you'll probably have to pay taxes on that $1,000 that they give you. We can talk.
Let's be realistic, and I don't mean to sound critical. I mean, nobody's going to say no to $1,000, but is that really going to stem the tide of foreclosure if somebody's really having problems? No. I worry about the political aspect of it rather than the economic aspect of it.
Yeah,
it's $1,000 over a couple of months is not going to make a difference to anyone's life, unfortunately. I mean, don't get me wrong. It's a nice gesture. Nobody's going to say no.
What are you kidding? I can go buy a bottle of hooch and some cigarettes. Come on, Bill.
Well, I would make the argument, gas down to $13, a barrel, that's a bigger tax cut for you. We all just got a nice tax cut thanks to oil prices. That's more of an impact to the economy.
That's true.
And to you and I as consumers, that's a tax cut.
Yeah, big time, especially out in California where we have massive taxes on it. All right, cool. So cash shortage, we talked about the repo market, the Fed, and their intentions. And obviously, they're doing this to keep some semblance of stability to a financial system, which right now is being shocked.
Right.
I want to circle back to one other topic. When you were on Power Trading Radio several months back, you kind of raised an eyebrow and you said, look, one of the things that really scares me right now is the corporate debt market. And you're seeing a lot more risk taken on there. The ratings are dropping like flies down on the corporate side. And here we are in a situation, and this should be scaring everybody out there. It was kind of like the Fed buying the bad mortgage-backed securities. You have the Fed stepping up and saying, okay, we're going to start buying corporate debt, which we're seeing the ratings on those drop. So basically what you were fearing, which was potential defaults and these banks corporations taking on too much risk, all of a sudden now you have the Fed coming in, knight in shining armor, propping that up. What risks do you think that poses for our economy?
Well, unfortunately, and this is where I sound callous,
we like that.
Corporations do have to die sometimes.
Yeah.
I'm not sure, and maybe I'm giving too much opinion here. When the airlines have used 93% of their earnings over the last 10 years to simply buy back their stock price, buy back their stocks rather than actually build their businesses. Maybe I give too much opinion here, but I'm not sure it's the Fed's job to be bailing out corporations. But by giving them short-term funding through commercial paper, they are improving their balance sheet. They're giving them cash, and that's what the Fed under Powell wants to do. We want to give everybody cash, including corporations. But I do want to add the cautionary note where I know you were going with this, Merlin, is, if you look at the corporate bond market right now, 50% of all of the corporate bonds in the U.S. are BBB rated. That's one notch above junk. 54% of the corporate bond market is one notch away from junk. If we go into a recession, you're going to see huge, not defaults necessarily, but corporations going from investment grade down into junk. Just this year so far, we've already seen more this year than we saw all of last year, including good names like Macy's, Heinz, Kraft, have all dropped into that category. So you got to worry. If you look, for example, at the BlackRock high yield ETF, they had $2 billion in withdrawals last week. They're seeing huge exodus to that because what's happening here is, up until today, the risk-free rates were dropping. The treasury rates were dropping.
Right.
But credit spreads on corporate bond paper is widening out because it is now more speculative to lend money to corporate America. So the fact that 50% of the corporate bond market is one notch away from junk, I'm not going to lie, scares me.
Yeah.
Because most portfolios can't own junk.
Well,
so if and when those bonds get downgraded, they're going to have to liquidate those bonds.
Right. TJ, bring up the chart here. I just brought up JNK, which is a high-yield bond fund. We won't call them junk.
Same.
But, but I wanted to show you the scale here, guys. This goes back into 2019, into May, June, July. And you guys can see there's been some swings, right? You can see the low here back in June of 2019 was right around 105 for that bond ETF. And it peaked out, let's say, at 110. So you have a $5 swing, not a lot. And you would expect there to be some stability in bonds. Watch what happens as soon as we switch into February here. Watch the scale change right about there. You notice all of a sudden it just disappears. So that stability that you had in bonds, which is generally supposed to be the goal of bonds, is give your portfolio some stability as well as some income stream through the payments on the interest and the yield. Look what's happened. These are the withdrawals. We've gone from 110 all the way down to a low, which was sub 90 today. Unfortunately, it's going to be off the side of the chart here. I can't read the exact number, but we hit a low of 88.59, and that's in a period of a little under 1 month. Now, keep in mind that for the better part of a year and a half before that, we only went from 105 to 110, and now we've gone from 110 all the way down to 88. So this is showing you a huge change in a market that is generally rather stable. A lot of people are looking at this as we have in our courses, saying, look, there are three bubbles right now: the housing, the equity, and the bond market. And the bond market is probably the most dangerous one of these. To me, the steps that the Fed did over the last couple of days in saying they're going to start massive injections into the bond markets, maybe buying corporate debt, is a shot to try to stop this. Because if this bubble craters, I think we're in for much bigger problems.
Yes, and again, I don't want to appear like the angel of death, only talking about negatives. But, there was even talk today in Congress about insuring money market funds. Because remember, we had back in 2008 when that commercial paper crisis hit, the money market funds that most people think are guaranteed at $1 a share, which is not guaranteed,
right.
That became a problem. So we're looking at a potential CP problem here. Some traders were talking earlier this week that the commercial paper market here in the U.S. just basically froze up this week. That's why the Fed is coming in as a buyer. So I just want to caution people, if you have a money market fund, that $1 per share is not guaranteed. Right. And although we haven't had volatility to that, except for a few times back in 2008, we just that commercial paper is not something that individuals invest in directly. But if you look at your money market funds, they're investing in commercial paper aggressively. So something to be wary of.
Yeah, no, lots that could be concerned about. When I see the Fed go as aggressively as they have over the past few days, let's say, a couple weeks, it scares me. And at this point, I would look to our political leaders, our financial system, to give us some sense of relax, it's okay, everything will be all right. And instead, what the Fed did is just basically, I used an analogy the other day where, it might have been a bad one. I said, you're in a crowded movie theater, and somebody yells fire, and then the guy in the projection booth just plays a little video of fire on the screen, and all of a sudden, it's a stampede, right? People are running to the doors, they're kicking each other out of the way. And I said, what the Fed's doing right now is like standing outside, waving their hand, going, free popcorn, and whispering it, right? And nobody even knows that they're standing there. I would say that maybe I have to change that analogy. And in this scenario, the Fed was actually in the movie theater, and they're kicking people to get out of the way. They're like, move, I'm getting out of here first. No need to remain calm. Freak out. I'm running you over.
Yeah. By the way, I will steal that popcorn analogy. I like that. The Fed standing outside offering popcorn and no one's paying attention. Because that's what happened to the Sunday night announcement.
Yeah.
Nobody's paying attention.
And whispering. They're not yelling. They're going, hey, popcorn, over here. I'm on the side. Shh. I know. There's a fire. Well, tell you what, Bill, do you got any engagements, any gigs? I know the articles or anything coming up here. I know our viewers always love having you on. So
traveling has shut down. As of last week, my business, in terms of the traveling aspect, we're going to move a lot onto virtual classrooms. So I'll be doing a lot on the virtual side. But it's all really for private clients. I travel around for different banks and dealer firms. So most of my business is institutionally oriented. So I'm going to be continuing with a series of virtual classrooms for them. But I'm looking forward to hooking in with you on a regular basis here. I enjoyed these sessions.
Yeah. And I think it's interesting because years ago when I would do the show, I would say, we want to focus on just let's look at stocks, let's look at futures, look at maybe some options and Forex. But the bond market is so integral to what we do and is such a driver of things. And right now you look at a lot of the actions that the Fed has performed, which obviously it's trying to stabilize our economy and push it back up. A lot of that has been done to prop up this bond market and keep things rosy. So there's going to be a lot more talk about bonds going forward. Bill Addiss, thank you so much for joining us today. I hope you have a fantastic weekend. I'm sure you're all quarantined and locked down in your home, so best to you and your family out there.
It's the same to you. Enjoy California and the better weather than we're having here on the East Coast. But we'll talk again soon, and I look forward to this, Merlin. Thank you.
Thank you so much. Take care.
All righty. Cheers, group.
Guys, that was Bill Addiss. We'll have him on the program a lot more. I know we went on a variety of different topics there, but because it's been so long since I've had him on, and there was so much to talk about with regards to the bond markets. Very interesting how this is starting to play out in the bond market, and I think that the actions by the Fed may provide a little bit of a floor to some of these junk bonds, but I don't think it gets us out of the woods at all. I think that there's still a major problem with the corporate debt market, which is really what Bill was focusing on several months ago on Power Trading Radio. Does it stop? Do we get, with zero interest rate policy, more stability from these corporate debt offerings? I don't know. I don't know what that's going to offer. I'll defer to Bill for that one. Oh, I'm sorry, Austin. I just got off the phone with Bill. If you have time, any 401k advice? How low can we go? Big Eb asked this a while back, so shout out to Big Eb in our chat over here. He says, do you think, and correct me if I'm wrong, Big Eb, but you were asking me a week or so ago, do you think that we'll get back to the 2008 lows that we hit in December? And my response was, yeah, I think that's a real possibility. I think we could go much lower than that. How low do we go? I don't know. I mean, obviously, I don't have the crystal ball. I think that it's going to get a lot worse, unfortunately. I have been encouraging as many of my family and friends to get out of their 401ks or whatever holdings and just go to cash or a cash equivalent, something that, as Bill pointed out, money market funds, which are supposed to be one-to-one, but at least you're not going to be subject to another 30 or 40 or 50% down move in the equity markets. I do think we could go much lower. It could go a lot. Trent says, I think we'll go to 2,000 or lower. I think that's a very real target. I mean, if you think about it, we're at 2,500 right now on the, well, we're actually a little bit lower. We're 2,400 on the S&P right now. That's only 400 points down. I mean, that's not like a major slide from here, considering we're seeing market moves of 9, 10, 11%. So not saying we could be there by Friday, but actually, we could at the rate things are moving. I do think we'll get there because think about it. If everything right now is on shutdown for 2 more weeks, now I don't know where it is in your respective areas of the country, but I know right here in Southern California, we're on lockdown. We received a statement last night saying you're not allowed to have anybody even over to your house. I'm not going to say I violated some laws last night by having a friend over for a drink, but we did keep 6 feet worth of distance. I don't know where it is, what it's like for you in your areas of the country, but if it's going to be in place for another 2 weeks and possibly another month after that, just think about all these businesses. You are going to have big layoffs. You're going to have a lot of uncertainty. I actually watched some of my friends last night posting on social media that they just lost their jobs. I'm like, man, this is quick. You know, and these guys have been working for 20 years. I think you'll see it get worse. That's why I've been saying short these rallies. I've actually been caught because I've been trying to play some pops back up. I just find it hard to believe that a market will drop 11, 12, 20% in the case of crude oil. We're down almost 22% in crude oil today at the end of during the trading session, that it's not going to have some little bounce back up. I mean, it's just an unbelievable type of move, and unfortunately, I got caught on some of those trades. But my bias, I think, at this point is to the south side. Yeah, and Kevin's right here. Says, he's just got laid off. I'm sorry to hear that, man. But what's crazy is you're going to be the new norm. This is the new normal. The problem is going to be, what are you going to do? You're laid off. Who's going to hire right now? See, in a normal environment, you could do what? You could lose your job, and then you go work somewhere else, find another job, because there's tons out there. There's not going to be much out there unless maybe you become a delivery driver for Uber Eats or Grubhub, which we talked about a couple weeks ago on the show as opportunities in this market. They're booming. Right now, probably a truck driver bringing groceries to the stores is going to be a hot commodity. But yeah, it's very, very tough to navigate a market where people are getting laid off left and right. Mnuchin's comments about 20% unemployment seems shocking, but it's a very real reality if all of a sudden this continues for any period of time. Let's see. Let me see real quick. Oh, unfortunately, Todd, you sent in a question, but I didn't get to write it all down. I'm sorry about that one. I don't know why I didn't get these questions all written down. One of the questions that came through was, when the market's bottom, how do you know that it's bottomed? You don't. Right? You can think that you're buying the bottom. Back in the 2009 lows, in our XLTs at Online Trading Academy, they were talking about having a demand zone at that 666 level. It's actually recorded somewhere in the archives. But there were also demand levels before it got down to 666. So basically what you do is you say, here are points where I feel things might turn. Of course, when it's that aggressive, you're going to take a step back and look at the bigger time frames, right? You're not going to be doing it on a 5-minute. You're looking on the weeklies, maybe even the monthly. So you find a nice demand zone, you take a shot at it. If it doesn't work, you got to lick your wounds, get out, and move on to the next one and find that next demand zone. I don't know when this thing's going to turn. It would be very interesting to see if Rick Wright's premonition came true. Rick Wright was making a statement on the show where he says, I got a crazy, crazy hypothesis. And he says, if you look at reversion to the mean, he says, I think you could see significant declines in the market. And I said, to what extent? And I'm going to actually have TJ draw it out here. TJ, go back to the highs that we had in recently, and I want you to go down 80%. Now, you guys might remember this, for those of you who followed Power Trading Radio in the past. Rick Wright was saying we could see an 80% drop in the equity markets. And I went, you got to be freaking kidding me. I mean, come on, that's crazy to think we could get that low. And he says, it's not. I mean, getting 80% drop would bring us back down to the 2009 lows, which seems inconceivable at this point. I should bring on my Princess Bride accent or impersonations. Inconceivable! Well, is it? I mean, I'll put a horizontal line at those 2009 lows. I'll tell you what, if it gets to 2009 lows, I'm buying everything that I can. Now we'll take that line off. So you can see, obviously, we're a long, long way away from that 2009. Brendan said 70% drop. But yeah, I know Rick Wright was on the show saying 80%, and I laughed at it because it's hard to fathom a market that crashes like that. But when the infrastructure, the consumption. We're not allowed to leave our home. So what are you guys going to do? You're not going to anything that's going to do with supporting events in your community. You're going to go to a grocery store, or you're going to go to a restaurant. Basically, who wins here? The delivery companies, restaurants. You're going to look at who else? Netflix, Hulu, these types of companies, so you can stay home. Streaming sites right now are going to be doing very, very well. Other than that, the rest of the economy is going to get slaughtered. So yeah, I think we're going to go much lower. I don't know when it is going to end. Hopefully it'll end at some point, from my just greedy trading mind, considerably lower. I know that's going to hurt a lot of people there, but Kevin says, I'm going to start choosing demand zones and slowly get back in, but I'm not starting until it hits 50%. Yeah, and 50% I don't think would be that far-fetched. What TJ, just give me a number, ballpark, about where 50% retracement would be. It doesn't have to be exact, but you can give me a ballpark number. Let's go. That 50% from this should be, of course, it should be simple math, but I wanted to do it on a chart. About 1,700 on the S&P should be about a 50% slide. Crazy, right? All right, that will do. Austin says gun companies too. Yeah, but now you can't even go to the gun stores, right? You have to do gun sales online. I'm sure that'll be booming as well. All right, crazy talk out there today. I hope you guys enjoyed that session with Bill Addiss. He's got a wealth of information. What I'd love from you guys, obviously, is to give me some feedback. If there's things that you want to know more about specific market segments, maybe more about specific repos or bond markets, I'll find these experts and bring them on this show. You can always send in questions 24 hours a day, 7 days a week at tradermerlin.com. Little form right there on the page. I know it's a cryptic page. I just haven't taken the time or effort to build out something new because I'm setting up a studio in my home, which is going to look very different than what we have out here today. I'm going to be taking a bunch of steps back with regards to technology, that's for sure, and hopefully everything will be fine. But yeah, we will answer any questions you guys have. Of course, we always love the chat. If you like today's show, give us a thumbs up. Please feel free to give us some comments and share with it. The best thing you guys can do to help me with this show is to recommend the iTunes podcast to your friends. Leave some comments on the iTunes podcast as well so I can get in that top 10. That's my goal. Until then, happy trading, everybody. I'll see you guys tomorrow with we might be doing a very, very, very strange show tomorrow. If I can pull this off, we're going to be in a remote location doing a live broadcast from a location, probably illegally, but we'll see how that goes. Otherwise, I will probably be doing the show solo, so I would encourage you guys to tune in and find out what's going to happen on tomorrow's show. That'll do it for today, guys, everybody. Thank you so much. Have a great one. See you tomorrow.
The Trader Merlin Show is produced by Merlin Rothfeld, Gary Christmas, and TJ Writings. The show is engineered and edited by TJ Writings. For more information, visit tradermerlin.com.